Hi guys, I am AP. In this video, we are going to see why should we invest in bonds. Okay, let's get started. Okay, now let us see why should anyone to invest in bonds. Okay, there are three main reasons. First one is to beat the inflation, and second one is to have a regular fixed income, and third one is to have a diversification in their portfolio. Okay, the first point is to beat the inflation. Before that, let us know what is inflation. And inflation is an increase in the price of goods and services. The most well-known indicator for the inflation is Consumer Price Index, shortly called CPI, which measures the percentage change in the price of basket of goods and services by a household. Okay, let me explain. To measure the inflation, there is an indicator named the Consumer Price Index. Okay, we seen before that the CPI is a basket of goods. Now let us see what are the things which is mentioned in the basket of goods. Around 43% for housing, how much rent increases, how much the land price increases. That's also inside the bucket. In foods and beverages, it's also included the vegetable price also, and transportation cost, and education and communication, how much the fees for the students increases, and apparel is a dressing and cloth, how much percentage that, how much that increases. It's all in a basket of goods. Okay, for simplification, now let us see it's a basket of goods. It's a basket of goods. Now we are in 2023. Now the basket of goods, let's say, cost 100 rupees. Then if the same basket of goods price, let's say, changed into 110 rupees in 2024, then the inflation which we are occurring is around 10 percentage. Okay, it's inflation, meaning is the rise in price of goods and services. How much percentage the price changed from the previous year to current year, which is measured, and the name for it is inflation. And by seeing the CPI index, we all come to know that this much percentage the inflation is increased. Okay, basically there are two indicators that tell us the how much inflation occurs in an economy, that is wholesale price index and consumer price index. The wholesale price index, which comes under the wholesale level, which tracks the wholesale trading level, what are all the prices, how much percentage they change. And the consumer price index will be calculated in a household level, that is a family is buying a goods for their needs for this year and how much it costs for the next year. That change in percentage will indicated by the consumer price index. Okay, now our aim is to invest in bond and beat the inflation. Okay, now the before example we seen that in, now if a basket of goods cost 100 rupees, then at 2024 it cost around, for example, 110 rupees. Okay, then it's a 10 percentage increase in value. Now we have three scenarios. One, keeping that 100 rupees in cash format, then at 2024 also it will cost around only 100 rupees. Okay, now let us see if we invest that 100 rupees in FD. The FD interest the bank pays will always less or equal to the inflation. If the inflation is 10%, then the bank only offers 8% interest. Then our amount will become 108 rupees at 2024. Now let us see if we invest that 100 rupees in a bond which provides 12% interest, then our money will become 112 rupees. Okay, now here we have a negative return of 10 rupees, and here we have a negative return of 2 rupees, that is 2%, and here 10%. And if only we invest in a bond which provides 12%, then our return will be positive 2%. It is the positive return. But in case of if we have the 100 rupees in cash and FD, we have a negative return. Okay, it is the first point we should consider, that we should invest in bonds. Okay, the second point is to get a regular income. A regular income is that is received at a fixed or uniform intervals. Now the income we are going to receive as interest while investing in a bond. Okay, now let me explain. Okay, now let me explain what's the difference between a regular income and an irregular income. Okay, now let's see if you invest in a 100 rupees in a stocks. The stock market can go up and go down, and even if our investment value can go up to negative. Okay, now in the bond market, if we invest our 100 rupees in 2023, then we are investing in a fixed interval that for every quarter the bond may issue the interest for us. Okay, like for every 3 months our bond will give a return for us. Okay, now let us see. I am invested in a bond which gives 10% interest, that is 110 rupees. At the maturity I will get 110 rupees for the investment I have done for rupees 100. The 10 rupees interest will be divided into 4, and we will get at the first quarter we get around 100 102.5 rupees, and next we get 105 rupees, and the next quarter we get 107.5 rupees, and at the maturity, that is 2024, we get our 2.5 rupees interest plus 110 rupees. It is how bond works. We in the bond we know that at the fixed regular interval time we are going to get our interest payment. It is the advantage in the bond. Okay, the third point we should consider is portfolio diversification. Portfolio diversification is a process of investing your money in different asset classes and securities in order to minimize the overall risk of their portfolio. To diversify our portfolio, bond plays an important role because we are beating the inflation as well as we are getting the regular income, so that we may not completely rely on one source for our income. Okay, if we have a 100 rupees income, then we are diversifying that money in terms of percentage and we are going to invest. Okay, it comes around 50% for our needs and fun activity, and 10% for our emergency fund, and 10% for insurance, and in 10% we are going to invest in our fixed income. Okay, that is real estate and bonds, and remaining 20% only we are going to invest in our index funds and in individual stocks. Okay, in case of any panic in market or economy, even our stock portfolio gives a negative return, we also have a bonds and gold in our portfolio so that it may counterbalance it. Okay, let me conclude this video by saying that while investing in bonds, we should have these three things in our mind. The first thing is we should going to invest so that we are going to beat the inflation by a small margin, and second one is to get a regular income from our bond, and third one is to have a diversification in our portfolio. Okay, these are the three main reasons why we should need to invest in our bond. Next video we are going to see about what are the risk and reward and how the bond is priced, and we are going to see about that. Till then, stay tuned. Thank you.